All right. Good afternoon. Excuse my tech hat if you're not a tech softball fan, or if you believe in the $1 million girl, or if you're a UT fan. We're in a house divided. I've got my A&M shirt on. My daughter can't decide on A&M or tech. So anyway, that's where we are. But I told you guys that I was going to start doing some more videos, and if I don't do them, it's just not going to happen. But so I thought every day or every other day, I'm going to give you a question about, something I had, something that hit me. So today a client calls me. Let me go through this in my memory real quick. And she emailed me actually and said, we're needing to sell my mother's house. Her mother had passed away. There are 5 heirs. We're going to sell it to one of the heirs. How do we do this? Is there going to be gain? Do I sell it in the estate's name? Do I sell it in my mother's name? Do I transfer ownership to the heirs? Now, I'm going to start off. I am not an attorney. Don't pretend to be one. And this is not personalized advice. This was my advice to her because she's a client and I know her situation. So, first of all, let's talk about gain or loss. When a person passes, generally, with the very few exceptions, generally, they received a stepped up basis in these assets. So, person passes and owns several assets. They could be retirement accounts, not IRAs. You don't get stepped up basis when tax hasn't been paid on those assets. So there's no stepped up basis in an IRA. I'm not going to get into that. It takes away from the subject. Cars, gold, jewelry, collectibles, homes, any other real estate, lake property, whatever. So generally the attorney will ask you, give me an inventory of the assets. Tell me what they are and give me a value. People, clients, the human nature is to value those things as low as possible. If you're not in some estate tax issue where your client, person dies with $15 million, $20 million worth of assets, you don't have to worry about it. But you want to value those things at fair market value. You want to be accurate. You don't want to try to value them low. You don't want to take necessarily the latest property tax assessment and take that value. That's not right. Because those items get a stepped up basis, you want to value those higher or within fair limits, but on the higher side. You don't want to be conservative when it comes to valuing those assets for estate tax purposes. If you're in a situation where you may have a taxable estate, then maybe you consult with your attorney, your CPA, and maybe you do. But generally have that question with your attorney, CPA, whatever. Ask them. In her case, this was just a mom, passed away with a house. She had some other assets, but nothing significant. They want to take the home. I mean, they bought this thing or built this thing 30, 40, 50 years ago, and it's worth, almost $1 million now. And I asked her, that was my first question, what did you value it at for the attorney on the inventory list for probate? And we're in Texas. Some states may differ. I'm telling you about Texas in general tax law. She told me, and it was a fairly high amount, and I was happy with that. So with that amount, I told her there really was going to be no gain or loss, and technically there shouldn't. I mean, if you value the asset at what fair value is and you list it the next day, you should get exactly what you value it for, or you didn't value it at fair value. You were off. But that's beside the point. My point with that is when you provide that stuff to the attorney, value it at fair value. If you need to, get an appraisal, and I would. If there are any sorts of issues. For instance, I had a client passed away. He owned a condo in Houston with a lower value now than what he paid for it. So there was no stepped up basis at all. There was an inherent loss in that property. So you want to get an appraisal if there's any kind of money involved. If you're selling to a third party, you may just get a pseudo appraisal. You may ask a realtor, something like that, to do comparables, whatever. My point is value the asset at fair value. Now, when selling the asset, this is going to a related party. So needs to be at arm's length. And they are selling the home for what it's worth. And she asked me about taxes, and I told her there won't be any tax. The stepped up basis, you take your proceeds minus your stepped up cost basis, and there's no gain or loss. So there is no tax liability associated with the sale. Then she asked, how do I report it? And I said, well, whose name is the home in? Well, her mother's. And I said, well, whose name are you going to transfer the home to? The home has to be transferred either to the estate or directly to the heirs if it's in accordance with the will. And then you have 4 heirs getting 1099 S's from the proceeds of real estate. And I suggested to her that she just have the attorney, since he's the executor, transfer the house to the estate of, put it in the estate's name, and have the estate sell the home then to the one heir who's interested in buying it. And that's what they're going to do. And then she then asked me about tax ramifications. And I said, there are none really, because there's no gain or loss associated with that. But if you have a situation where you may have other items of income or loss, or there may be a gain. You list the property, you value it at a certain amount, you list it, and it takes you a year and a half to sell. There could be gains if the property increased in value. So if you have that situation, you don't necessarily want to put it into the estate's name. You could, but you'll want those taxes, any of those gains, rolled out to the beneficiaries on a K-1. You have to be careful, because unless it's the final year of the estate, that tax return won't roll out capital gains. It'll maintain those. Capital losses. So you have to be careful on that. My point is, you need to evaluate more than just, hey, we inherited a house and we sold it. What's the tax effect? What do we do? There is no right answer. There is no one right answer, I should say. There are multiple answers, and it depends on the facts and the circumstances. So I just want to throw this out there to you that, number one, don't forget about a stepped up basis. I'm thinking if I want to go down this road. Number two, while we're talking about stepped up basis, don't forget a husband and a wife receives, in Texas at least, a stepped up basis in the entire value of the property. So if a husband passes away and a wife inherits the property, she receives a full stepped up basis. And any assets in a brokerage account that are properly titled receives a full stepped up basis. That's why you see these brokerage accounts titled in tenants in common rather than joint with rights of survivorship. There's a difference. Speak to an attorney, speak to a CPA. I'm not going to even try to tell you the differences, because I don't want someone coming back saying, hey, he said, and here I am on the hook. This is not personal advice. I'm just telling you what to ask. I want you to have the questions and the ammunition to go in and speak to an attorney or CPA about these things. Don't forget, when a husband or wife passes away, the other spouse gets a stepped up basis, at least that way in a community property state like Texas. Then there is the need to file a formal estate tax return even though you don't have a taxable estate, to do what's called elect portability. Right now, when a person dies, they can gift, let's say, I'm not going to give you the exact number because it changes. Let's say 15 million. It's about where it is. You can die and give 15 million to whoever, spouse, whatever. Let's say you have a $20 million estate. So the husband dies, he gives his half, 15 million, to the spouse. No problem. And to the spouse, it's unlimited. But what if the spouse then turns around and dies? This is just one pile of assets, $20 million worth. But together, he has 15 million and she has 15 million. How is it that he dies, the money's left to her, she dies, and now she gives away the 20 million, and now there's $5 million there that's taxable because she could only give away 15 million. It's not fair, right? Right. That's why you file an estate tax return when the first spouse dies, the husband, to elect portability of his exemption. He has 15 million, he dies, gives it to his wife. He transfers the unused portion to the wife. Now she has all of hers plus what's left of his, so that when she dies, now her $20 million gift or estate is not taxable. So that's item number 2 when we start talking about estates and taxability of assets, things like that. I just wanted to go down this. My client had some other items that existed, which was, she had some mineral interest. I advised her, transfer those mineral interests. They need to be listed on the estate. They may not be worth very much, but transfer those because in the future, they may very well be worth something. So I just wanted to throw that at you guys. If you find yourself in a situation where you have a loved one that passed away, they have assets, you need to now value them on an inventory for an attorney. You're the executor of an estate or what have you. Do that. Set up the estate, get the EIN number, transfer the assets properly, go to an attorney, go to a CPA, give them the specific details. But remember, don't try to value that asset on the low end of the spectrum unless there's precedent and reason for doing so. Precedent being you've got a family limited partnership, you've got some other estate planning tool that was set up because you've got a high value estate. Those people don't need advice from me. They've got their professionals that they're working with. I've got my clients that I work with that we do estate planning for. And so we know the details. They know the details because we meet every year when we talk about it. And 95% or 99% of the cases, you'll have a person that passes away with just modest assets, and you'll transfer those assets. But, this question comes up a lot. Do I have any tax to pay on that or inheritance at all? My dad passed away, he left me $100,000, $50,000. Do I pay tax on that? No. You don't pay tax on any inheritance unless it's an inherited IRA, something that has not had tax paid on it yet. That's the biggest thing, an inherited IRA, pension plan, something like that. So anyway, I just thought I would throw that at you guys and let you know, hey, one more item. I'm going to, and like I say, I'm going to start throwing these questions in. And if you listen to me, fine. If you have a question and you want more specifics, shoot me a message, put a message down in there, and I'll respond. But I'm just going to try to do this daily, maybe every other day. Depends on how cumbersome the editing process gets. So we'll throw these questions out there, questions I get every day. If you'll follow and subscribe and like, you can listen to my answers. The questions don't apply, ignore it. If they do, maybe they give you some ammunition so you can talk to your professional and feel like you at least have a little bit of knowledge about the subject. And guess what? It's free. So I appreciate it. Text.